Hi, thank you so much for joining me for this webinar. I'll be going through the full process of how I approach investments and trades, going into all the tiny details to make sure that I show you exactly what needs to be done in order to have consistency in your investment and trading journey. I'll also be answering some of the questions I've received over the past few weeks from people who were asking about specific subjects, including how to start with a small amount, options, futures and CFDs, risk management, and some other topics. What makes this very different from all other investment and trading educational videos is that the fact that I will be showing you how institutions approach the markets and how they profit consistently. This is completely different from anything else you'll see, since this insider view into how institutions do it hasn't been shown before, and I am showing it to you right here, right now, in full, without missing any details along the way. This is a very thorough process, so stick with me until the end to make sure you do not skip any steps. The whole process consists of 8 steps, and I'll go through each of them in detail with actual real-life examples. For every step or any example I show, I will also be sharing the exact tools I use, such as brokers, charting tools, indicators, services, etc. And I will include links for these and some other useful resources at the end of the webinar. This is going to be suitable for both beginners with tiny accounts as well as experienced professionals with larger accounts with high leverage. So even if you consider yourself to be an experienced trader or investor, I'm confident that you'll find a few tips here that will make all the difference in your journey through the financial markets. You'll need to make sure you dedicate the next 75 to 90 minutes roughly or so to following this webinar. Get a pen and paper and take notes, because we have a lot to go through. And I am sure this hour will be one of the most useful hours you're going to be spending this year, as it will set you up for consistent success. Also, if you stick to the end, I have 4 amazing gifts for you to help you out on your daily trading and investing. Now, just in case you're asking yourself, who the heck is this guy and why should I listen to him? My name is Hassan Afifi. I have been investing and trading since 1995, and I have worked as an economic analyst and equities advisor to some of the largest institutions in the world. I would love to hear from you in the chat here how long you've been trading or investing. Okay, we have here, okay, complete beginner and would love to learn. This lady here is saying, been trading 30 years and always looking to learn something new. Well, I hope you'll find something useful here. I have my first $1,000 to invest and I don't know where to start. Well, hopefully by the end of this webinar you'll have some idea. I consider myself an expert investor and need more consistency. Well, this is what this webinar is all about. Okay, someone is asking, where are you from? I'm originally from Egypt, but I have been living in the UK for nearly 19 years now. I've studied in the US, Egypt and the UK, and lived and worked in quite a few countries. It would be nice to hear where you're from. Please write in the chat where you're from. I'll take a look at the participant list here. Okay, so we have, wow, okay, well, this went up quite quickly. So we have over 200 and something from the US, 119 people from California. Well, shout out to California. A lot from Georgia, Arkansas, Washington, South Carolina, Colorado, New York, Delaware, Washington DC. We have a lot from the UK, yep. Canada, Netherlands, very nice country, Belgium, Portugal. My last holiday before the lockdown was to Portugal. Australia, Austria, one of the most beautiful countries in the world. Colombia, wow. Germany, Luxembourg, I've been many times to Luxembourg. Norway, New Zealand, wow, I really did not expect that many countries to be participating, so thank you so much. Wow, thanks very much for joining me from wherever you are. Anyway, Back to what we were doing, I shouldn't get distracted. My job as financial markets analyst basically involved two main roles. The first was to scan the markets for investment ideas for these institutions, making sure they had solid fundamentals and that they had the best chance of generating the desired profits. This involved me working with my sector analysts and economists, meeting government officials, central banks, and ministers of different countries, as well as meeting with different company managements, visiting factories or production facilities, and conducting market research to ensure these companies were solid. And I can tell you that over the years, I have done this hundreds of times all over the world across almost any industry you can think of. It was educational, fun, and tiring, but most importantly, these meetings, visits, analysis, and discussions with investors and traders made me learn very important lessons about spotting companies which could be taken seriously and others that should just be ignored, and the best approaches to getting in and out of positions. My second role in this job involved interpreting news, chatter, and daily events into how the markets may be reacting in the short and medium terms, which was an important first step in the process of finding the right trade and taking the trades in the right direction. Understanding market dynamics and trying to sense the market sentiment before it is actually reflected in market movements has been my main strength for so many years. I have gone through some extreme market conditions, and this ability to interpret sentiment and spot catalysts has been a lifesaver for me and seen me and my institutional clients profit through the dot-com crash, the financial crisis, the Arab Spring, and most recently the 2020 COVID craziness. I'm going to explain exactly how I do all this in full details here in this webinar. I hope that by now you have your pen and paper ready, put your phone on silent, and put yourself in a place where you'll be free of distractions for the coming 75 to 90 minutes. So let's get into this. I'll start off by explaining the top-down concept. This process probably would not work with penny stocks. Penny stocks usually do not move on fundamentals or general market sentiment, so they are risky to invest in, and their stock prices move mainly on the back of some sudden change in sentiment towards it, which a lot of the time can be illogical, and we can see prices run ridiculous levels up and down just because everyone is trying to ride a wave. This is not a sustainable way of approaching the markets, and it is a great way to end up losing a lot of money. I would like you to always think in a way similar to institutions. Every time you are about to approach an idea, just try to think, what would institutions do? I'm sure most of you don't know what this involves, and this is exactly what I'll be detailing here. But anytime you think that this is not something an institutional investor would do, just walk away. Remember, we want sustainable profits and not just one-off hits followed by a ton of losses. Also, you need to decide on whether you are looking at an idea as an investment or a trade. Generally speaking, an investment is something that you would be committing to for many years to come, and you should consider yourself as a partner in the company if you're investing in equities, which is what a shareholder means. On the other hand, if you are trading, you are going to be more interested in the short-term supply and demand dynamics for the company's stock, which does not necessarily reflect anything to do with the actual company's operations or profitability. And when I'm talking about a company, that the same goes for commodities, forex, indices, crypto, or any asset class. The examples which I'll show you later should make this very clear. So, what is this top-down approach? The top-down approach means that we always start off by looking at the big picture and then working our way down until we reach the exact details of the investment or the trade idea. I'm hoping that once I go through all the steps, you'll see why most retail traders and investors tend to lose money, and that you can then turn this around and start to make consistent profits. Step one in Our top-down approach will be to look at the world from a bird's eye view. So this would mean that we form an opinion about our own expectations of economic and political scene. This is the macro view. You don't need to be an economist or political expert to reach this macro view, but you definitely need to take your emotions out from the equation and try to think about this objectively. So regardless of what your political views are, for example, if we're looking at election results, it is not about our opinion of either side that matters here, but what we think their actual effects on the economy or specific sectors will be. We can use the example of the US elections. We had the presidential elections first, then all the uncertainty surrounding it, and then the elections for Congress, which have been very close in both the House and the Senate. And I'm not even talking about the outcome, but I'm talking about the process. A general look at US politics can give us an idea that Democrats want to push for breaking up and taxing big tech, for example, while being in favor of green energy and legalizing cannabis. On the opposite side, Republicans are seen as against imposing more taxes, and they are in favor of oil companies. Another US political issue which has been ongoing and driving markets was the stimulus checks, supporting the general public, putting more cash directly in their hands, which would be seen as positive for consumption. If we look at the bigger picture of the economy, we could immediately see the effect of the global lockdown due to the COVID-19 pandemic and how it affected the world. We could also see some more local economic policies which are important, such as interest rate decisions by central banks. So, for example, if interest rates are increased, we know that this will probably mean more money will go into savings accounts and out of the financial markets in the country, or it will affect the country's currency. We'll get to these a bit later. Now, let's look a bit closer at how this can actually affect our investments and trades. Let's look back again at 2020 to see some examples of how this works. We've just mentioned the global lockdown, so let's think about this and how it affected different industries, both positively and negatively. Since I used to travel a lot, flying everywhere every couple of weeks, the first industry that comes to my mind when I look at, or when I think about the lockdown is the airlines industry. All of a sudden, no one was allowed to move within their own cities, let alone take flights anywhere. What this meant was that the whole airlines sector was extremely negatively affected. Now, do you think it would have been wise to go in and buy shares in airlines during March 2020 when governments were grounding flights? Of course not. Or what if you were already holding shares in an airline company? How would these global events have affected your decision on whether to stay in or sell out? Now, on the other hand, companies which were providing certain online services saw unprecedented and unexpected growth. Online shopping understandably increased because people couldn't get out to go shopping. Another factor that increased that shopping was the fact that people were getting extra financial support from their governments, so they had money, were staying at home, and needed to go to do the shopping. So, thinking about Amazon, for example. Or they wanted to make home improvements, whether to sort out some workspace at home or just to have a project during the summer to work on, not to get bored. So we could think about companies like Home Depot. Working from home meant everyone had to start using online meeting services, so companies that specialized in this, such as Zoom, saw unbelievable demand. Even companies that were not focused on this service but had it anyway, like Microsoft, saw massive growth from their online meeting services, as well as computer and tablet sales, of course, as everyone needed to get a device to be able to work or study. So, these were all companies, or what we call equities. We can also look at the effects of the macro picture on other asset classes. Let's think about commodities. The first commodity that got negatively affected was oil, of course. No transportation meant demand dried up suddenly, and all oil contracts were just a burden to those who were holding them. So physical places which stored oil barrels started to panic since they did not have the capacity to actually hold such high inventories, while the supply did not stop quick enough. Oil fields were still producing oil, and storage facilities started to get overwhelmed really quickly. The reaction of oil traders was that they wanted to get rid of their contracts at any price to make sure they did not receive more oil barrels. This is why we saw oil prices even go negative at one point, where traders were willing to even pay you to take the contract because they did not have the capacity physically to store any more oil, and it cost them less to pay people to take their contracts than actually just throwing these contracts away. Of course, this was an extreme case, but it is perfect to demonstrate the effects of the global economy on very specific investments or trades. On the opposite side, investors who were getting rid of their equities and other commodities like oil had cash and wanted to put it into something relatively safer. As soon as we hear safety, we usually think about gold. We then saw how gold prices reacted and then reached all-time highs since demand suddenly shot up, while we know that supply couldn't possibly keep up. How about forex? Let's have a look at a currency that was massively affected by politics over the past 4 years, and that is the sterling pound. Sterling movements have been largely caused by Brexit talks, or rather what people were expecting the talks to lead to. Every time there were news of the UK and the EU negotiating, we saw big movements. We also saw how the euro moved along with Germany's elections, or economic data coming out of Germany or France, or when the European Central Bank came out to talk about the economy or interest rates. There are some more complex relationships, such as currencies being affected by commodities, which are also affected by economic events. The Swiss franc, for example, is a currency that sometimes moves in correlation with gold. So, now that we know how the macro events affect investment and trading decisions, how do we get to the point of making up our minds ahead of time? There are so many sources and ways to develop our view. The starting point is that you probably already have a specific view without even noticing it, and now is the time to start tapping into your subconsciousness and get out these ideas. Watching the news is an essential part of this, and all current affairs may become causes of general direction in markets. There are also economic events such as governments announcing unemployment rates, central banks revising interest rates like we've mentioned earlier, or looking at oil inventory figures compared to what analysts were expecting. The good thing about economic data is that there is usually what is called a market consensus, which is the combination of what different analysts are expecting the data to be. We can then easily compare the data being released to what the market was expecting, and this way we can see whether this might have a positive or negative effect on certain asset classes. I'll show you examples of these later. You should not move on to making any investment or trading decision unless you have a clear macro view first. Always remember that you have to be convinced of the move that you're making, and that conviction won't be there until you have macro clarity. Don't worry, you won't have to do all this hard work, and I'll tell you later how I can help you with these. The second step in the process is a continuation of your macro view, and we start to make it a bit more specific. So we are now deciding on which themes are the strongest according to our macro conviction. We've already touched on the themes briefly, so we'll continue from the same examples we've just talked about. We can look at these two themes of airlines and online services as the two opposite ends of the spectrum in the economic environment of 2020. Back in April 2020, when we already saw most countries locking down, it would have been very easy to start seeing the themes develop. So we would have run away from airlines and focus our efforts on companies that provided online meetings, for example. If we had money in airline stocks, we would have taken them out. And if we didn't have money in it, we could have also shorted airline stocks if we believed they would go lower. If you don't know what shorting is, please take a note of it now and look it up when the webinar is done. On the opposite side, the money coming out of airlines could have easily gone into the online meeting stocks since the expectation was positive on those. And guess what institutions did? They did exactly that. We have seen the money flow from the sectors that were losing into the sectors that were making money with very clear themes in mind. Some of the other themes were not as convincing, so instruments in these themes didn't move much or moved erratically. An example of this was how markets reacted to prices of corn, wheat, or even silver. People just didn't know how these commodities would be affected by the political and economic events, and trading them was just not as clear as other themes. So you need to always find the themes that you are convinced with and that you see have strong foundations and clear directions. The third step is going to take the themes we've decided on in the last step and decide on how long these might last. There is no clear-cut rule for any of these, by the way, since all of this is down to your own perceptions. So themes and their durations can be very long or very short and anywhere in between. It doesn't matter as long as you have a clear idea. For investments, the theme duration needs to be expected to last at least a year or two, or for longer-term investments, some themes can last decades. For trading, you'll be looking for themes that have quick and sharp effects on the markets in the short term. The duration of the theme is going to be one of the strongest keys to unlocking your profitability in the period you're expecting your trade or investment to last. We will see later how we're going to use this exactly. But let's look once again into some examples. For instance, how long you think the airline industry will be struggling for and how quickly they can recover and when. These can have huge effects on how you approach potential investments or trades in the sector. If you believe that the vaccines would lead to the reopening of the world within 6 months, for example, that people will start traveling again and that airlines will have enough cash to survive until this happens, then it could lead you to start looking into some medium-term investments or multi-week swing trades. On the other hand, if you think that airlines will continue to struggle for some years to come and that vaccination will not mean quick recovery, then you might be looking at the airline industry in a completely different way, maybe even thinking of going short on some airline stocks. So as you can see, this theme duration is absolutely crucial in how you're going to be looking at what to do. In step 4, you'll start to draw a short list of the instruments that you want to trade in or invest in. Once you've decided on your theme and the duration of the theme, you'll need to start looking inside the theme to see which companies, commodities, or currencies that relate to your conclusions will be best placed to either benefit or lose from this. And we don't always just have to look at the instruments that will benefit, because we usually also have the option of going in the opposite direction. So if the theme points towards some potential declines, we can usually benefit from this as well. It is just important that we set our expectations and know which direction we want to go. Notice that until now, I haven't talked about prices, valuations, charts, trading, or any of this stuff. Of course, they're going to come up, but these can only be done after laying the proper foundation. Do not try to rush this process, otherwise you're going to get a rather nasty shock with very bad losses, and then when you think about it later, you'll see that you could have avoided it by just spending a bit of time talking about all of this macro view and taking the proper steps. Anyway, this initial bit of research that goes into creating the first shortlist will open your eyes to a lot of ideas and make you understand more about the sectors or industries you're looking at, which also comes in very handy if markets start to act irrationally. When this happens, you'll have the reassurance of your own solid foundation and you can stay the course. After step 5, I'll show you a really great and simple tool that will help us find specific stocks to include in our shortlist. In step 5, we start to look at prices and valuations. For investments, valuation is the most important factor you should be looking at. When you're investing, you are committing your money to something you believe in long term. If you're investing in a company, then you believe in the business and its management for years to come. You become a partner in the business, as we mentioned earlier. Think about how you would react if a person comes to you and tells you their story about their business they're running and that they want you as a shareholder in their company. If you watch shows like Shark Tank or Dragon's Den, then you know that investors are usually interested in specific areas, most important of which are the management, the market the company is operating in, production, and several other factors. These are the fundamentals of a company, and analyzing these is what we call fundamental analysis. Through analyzing all these different aspects of a business, we can reach some forecasts for the financial future of the company and in turn be able to value the company and reach what we believe should be the fair value of this business if it is to be sold today. Simple local businesses may be easy to value, while complex global enterprises are usually more complicated to run a valuation for. Luckily, we don't have to do this at all, and most of the fundamental analysis is available if we dig a bit around. Also, if you are someone who prefers to do their own fundamental analysis, then you can do this by gathering information that is publicly available to reach your own conclusions. These can be publicly available financial statements, news reports, management forecasts, which you can always find on the company website, and your macro view and theme preferences, of course. But we're not going to go into this here. I'm just going to show you how we can do a very quick scan to reach our investment targets. The main figure we want to see is the fundamental target price or fundamental fair value. This is the share price that analysts have reached after doing their fundamental analysis. We can easily find this on websites like Yahoo Finance, FinViz, or Stock Target Advisor. Let me show you on the screen here what we're looking for. This is the Yahoo Finance website. If we enter the company name we are looking for, let's say Amazon, okay, and then we choose it, we get to this page here with all kinds of information about the company and the stock. Now, if we scroll down a little, we get to a place on the right here, a little bit lower. Okay. It's just after this. And it says analyst price targets. It shows us there are 46 analysts who valued this company, and that the average of these, like the average target value, is 3,819.30. So that's the target. While it is currently trading at $3,168. So we know there is still upside here, or that if we buy this company's shares, we are not overpaying from a fundamental point of view. I'll include links to all these later, so you don't have to remember any of these for now. What these websites have as the target price is usually a collection of several analyst valuations. So they publish the consensus, which is either the average or the median of all their target prices. Now, why is this number important to you as an investor? It is because this is where you believe the company's shares should be trading at from a fundamental point of view if the market takes into consideration the company's actual business. You don't want to be overpaying for anything, especially if you're committing your hard-earned cash to a long-term investment. So we are always looking to invest in an undervalued instrument. So we go back to our short list from step 4 and start writing down the target price next to each of the names that on that list to see which ones are currently undervalued. And in a minute, I'll show you a rather simple shortcut to do all this in one go. But let me talk about price and price targets for trading first. The story here is quite different. While with investments, we are interested in the fundamentals of a company and the business it's in, concentrating on the actual valuation of the company. In trading, we are only interested in market dynamics of the company's shares being traded, which don't always have something to do with the fundamentals. The stock price always moves with market sentiment and speculation. For example, a company can have a very solid business, but the market may be going through a panic phase, so the share price might fall even though the business itself is doing great. This is why traders don't always look at fundamentals and just focus on the charts which reflect the dynamics of the stock price. So as a trader, you're only interested in the supply and demand dynamics for the stock itself. A good example of this is the panic that happened in tech company stock trading when Facebook faced litigation in the US calling for its breakdown. We saw all tech company stocks fall regardless of what these companies actually did or whether they might have faced similar lawsuits. This sell-off was due to market sentiment, which was negative towards all tech because one of the biggest names seemed to be facing trouble, ignoring any of the other companies' sales, growth, or such fundamentals. Traders have to be aware of these price movements and what caused them, while investors don't always care much about short-term moves because they make their money by being long-term shareholders in a business. Traders, on the other hand, make their money by buying and selling the shares. I hope you can see the difference here. Investors could also see such fall in prices as an opportunity to buy shares if they had one of the companies on their short list that was not undervalued, and then the share price drops for no good reason other than following the market sentiment, which would then present an opportunity for them to buy. Following the price movements for trading is done through technical analysis, where traders look at the charts and use certain indicators to analyze historical patterns to try and predict future prices. I'll talk more about technical analysis in a few minutes. This brings me back to one of the biggest differences that I have seen between retail traders and institutions. Most retail traders would look at the charts and indicators, follow some theories, and they do not have much knowledge about the dynamics of where the movements come from. They basically skip the first 5 or 6 steps of this 8-step process, not knowing what they're getting into. Institutions, on the other hand, would have to go through all this and look at the next step, which is one of the most important steps of all. But before we go to step 6, let's look at a way to jump through the previous steps we've just talked about. Several websites have what we call screeners or scanners, which are ways to sift through the thousands of different ideas and get to what we want quickly. For ideas, I personally use FinViz, since it has the most of what I'm looking for. Let me turn to my screen to show you this in action. Right, so we go to the FinViz website, find the screener in the menu, and click that. I'll include this website at the end with the list of all other links. If you are a person who likes your numbers, you can always take your time to discover this. But let me just walk you through this quickly. Start by clicking on all. I know there is a lot of information to look at, but you can just follow these steps if you can't be bothered. Now, first we have to remember our steps. In the first 2 steps, we chose our macro view and our themes. So this is the first step we are taking here. Let's say, for example, that one of the themes we are bullish on is gold. We have 2 places we can choose this on the screener: sector or industry. Sectors are more general, and industries are more specific, so there are more of them. So let's say we are bullish on gold and as an industry, so we'll pick this. The list now has 41 companies, but we're going to clean it up. Next, I don't want any stocks that are not traded regularly. What I want is a stock that is liquid enough, so I'll choose here from the average volume over 1 million, which means that we only want stocks that trade at least 1 million shares every day. I also don't want stocks that are dominated by retail traders because they can be irrational. So from these institutional transactions, I'll choose very positive, which means that institutions trade this stock regularly and at least 20% of the traded volume. Now we can see that the list has gone down to 2 only, but we're not finished yet. If we're bullish on the sector, we want companies to invest in, which means that we want companies that have a fundamental target price that is higher than the current price. So we go to target price and choose above price. This means that the analyst target prices for these stocks are higher than the current price. Now we have 1 company on the list. And just like that, we have our short list with the only company that has a fundamental target price that is higher than the current market price. We can then look into this to see whether it matches our general criteria so far. Let's have a quick look inside this company, KGC or Kinross Gold Corporation. When we go inside the page, we can immediately see a chart with some technical indicators on. This is then followed by this all-important table. The first thing I'll look for is the target price, which you can see here towards the right and just before halfway down. It says that the price is 1270. If we go up to look at the current price, we can see that the current price is 7.36. So we have over $5 of upside, or over 72% to go until we see the stock trading at the fundamental fair value. When we go down a little, we can see the most recent analyst updates for the company. So we can see that on the 6th of January, Barclays upgraded the company and their target price is $9 per share, and their recommendation is overweight, which means that they see this as still being as a good opportunity to accumulate shares in. In August, we can see Bank of America upgrading their view and target price. I would look at the most recent updates here, because I'm not interested in what analysts were thinking about this company in 2018, for example, because things change. I would also look at trends like whether brokers are becoming more positive or negative. We can see here that from April 2020, all brokers have upgraded their views, which should mean that there is improvement in this company, even more than what analysts used to think before. We can go back to the table. Other numbers we can look at here. One number I could be interested in is dividend yield. If this is one of the investment criteria, I usually look at this during uncertain times, because even if stock prices go down, we can still receive dividend from the company, and any cash received is always welcome. The table has other figures, both fundamental and technical, which you can also explore more if you want. We can also see some news about the company, then a brief intro about the company. On some company pages here on Finviz, you may also find financial statements. If you are into fundamental analysis, then this part should be important to you, because you can see most of the numbers you need for your analysis here. And some company pages will also have insider trading, which shows what management and major shareholders have been doing with their shares in the company, but that's a whole different subject for another time. Now let's resume our steps. Step 6 in the process is about finding catalysts. If there is one lesson that any trader should learn, is that they should never take any trade without having a specific catalyst in place. Even if the catalyst is speculative, it has to be present. Now, let me repeat this. You should never ever take any trade without having a clear catalyst in place. So, what is this catalyst and how do we find it? A catalyst simply is an event of any kind that could have an effect on price movement. There are many of these that are happening every day, so let's look at some examples. An earnings release of a company at the end of the month can be the catalyst needed to move the stock price, for example. If you expect the company's results to beat what the analysts are forecasting, then you would be expecting the share price to react positively, and this may affect your trading decision. Data such as unemployment figures are also catalysts for the general market. So, for example, if unemployment figures come out worse than what analysts estimated, you can see the S&P 500 index react negatively, since this fuels a bit of general pessimism in the markets. Crude oil inventories being less than estimates could mean that supply is underestimated, which could drive oil prices to go up. We also saw some political speculations act as market drivers in the run-up to the US presidential elections, where certain share prices of companies and sectors moved with the news or poll results of who was in the lead and the expectations on the back of that. These are all catalysts for trading, but we can also look at catalysts for investments, which may look slightly different. Investment catalysts could be factors that take years to develop. Some examples, again, from 2020, could have been software development for self-driving vehicles or space exploration, for example. These two are examples which have potential catalysts that may take years to happen, but one can argue that they could be game changers for companies involved in them. Some laws and regulations can also act as catalysts, both for trading and investing. I can think of environmental laws and regulations regarding emissions, which can act as catalysts for investors and traders to move money between energy companies relying on oil and green energy companies depending on the direction these regulations are expected to go and what governments are backing. In any case, catalysts always have to be present in your decision to trade or invest. Once all the 6 steps are completed, the decisions are then made about entries and exits. These may be a bit more straightforward to investors as they are related to fundamental fair value as mentioned earlier. For traders, it is all about the charts. Steps 7 and 8 are largely for traders, but investors should also be aware of some of the details in them, since they could benefit from such information for timing entries and exits in a better way. Step 7 is about choosing the time frame. One of the main questions traders tend to ask is about which time frames to use. Well, it all depends on the outcome of steps 3 and 6. In step 3, we have decided on the duration of the theme, and in step 6 we have identified a catalyst which we know should be happening at a specific point in the future. Combining these 2 factors together, and you can decide on which time frame to use on your chart. Now let me move on to my charts while talking about this so we can visualize it in an easier way. The website I use for charting is TradingView. Once in TradingView, I'll click on Charts and Start. I'm sure a lot of you are already familiar with TradingView and charts, but there are quite a few people here as well whom I know have never done this before or need a bit of help, so thank you for bearing with me. So we were talking about time frames. When we talk about the time frame, it means how long each of the candlesticks takes from start to finish. For example, this is the 4-hour time frame. So each of the candles is 4 hours. If I hover on the candles, you can see this one, for instance, is 2 p.m. And the next one started at 6 p.m. and so on. When we want to make very quick decisions, 4 hours might be a little bit too long, and we would want to see the action in a shorter time frame. So if our catalyst is going to happen today, for example, we will probably look at very short time frames for intraday trading. Common ones are 5, 15 or 60 minutes. So if we click on the 5 minutes here, this means that we are following the 5-minute time frame on the chart. As you can see, it is showing movements over the past few hours only. A catalyst happening at the end of the month or next month could make us move to the 4-hour time frame, since your trade is likely to last for days or even a couple of weeks. You can see that movements on the chart go back for days. As for investments, you'll want to look at the daily or weekly time frames, which should give you a better picture of what to expect over the long period of time you'll be holding your shares. You can see when we pick the daily time frame, the chart is showing the past 8 or 9 months. The weekly time frame immediately increases that period, and so on. This brings us to step 8 in our process, which is the choice of indicators to use on the chart. There are so many indicators that technical analysts use, and these can differ from one instrument to another and from one time frame to another, as well as many other factors. But I almost always use certain indicators regardless of what I'm doing, and they're great starting points. Let me show you this in action again on the chart. I'll pick gold and I'll choose the 4-hour time frame because it is my favorite time frame for gold. I always start with the following indicators on the chart. So we go up to the that function sign. I find the exponential moving average, and I put 4 of these on the chart. So I click it 4 times. Then I add the MACD, and RSI. Finally, I'll add the Lux Algo indicator. I'll include a link for this indicator at the end of the webinar, also along with the links of all the tools I'm using. The chart also needs, we need to add the volume. Forgot, sorry. I have to go back to add the volume. Right, so I click on the indicators, write volume, and pick that. Good. Now let's set up the indicators and explain quickly how to use them. I'll just adjust these so I can see everything properly. The first adjustment I make is to change the candlestick type to Heikin Ashi. I find it much better for spotting patterns, and it makes the chart easier to read. It is also necessary for one of the indicators I'm using here, which is the Lux Algo indicator. You don't really have to know exactly how it works, but it is basically, it uses different averages, and it's different from the normal candles because normal candles use open and close prices, and this uses averages. You can always look it up if you want more to learn more about it. I'll open this and start adjusting my indicators here. I'll start with the EMAs. The first one, I want the 8 EMA. I also want it to be green, because the colors matter here, because we want to immediately tell, and I want it a bit thicker to be easier to see. Okay, and then the next one, the next EMA, I will put 21, and I'll make it pink and thicker. Okay, and then the next one is our 50 EMA, which is an important one in gold, and I'll make it white and thick as well. The last one after this one, last EMA, is going to be the 200 EMA, so I'll change that input and put 200, and I'll make it orange and thick. Now you can see the moving averages. You can see clearly which one is which on the chart. Now the Lux Algo indicator, I want to see again, so we'll open that to go to inputs. I want to see the EQ cloud from the indicator overlay. I also want to see all signals from the top. Then the support and resistance, I want to actually see the predictive range. So up one, maybe, where is it? There it is. Okay, up. And then I will choose the predictive range. This is very handy. I also want to see the cloud. So I will change this in style. I go to cloud 1. Change it to crosses, and I will change the color to green, and I will make it 50% just to be able to see it. And then I'll go to cloud 2. I'll also change to crosses and make it pink and 50%. Now, This way our chart is set up. Another indicator which can sometimes be very useful to just look at the whole picture quickly is linear regression. So let's choose that, linear regression. It draws a channel that you can immediately look at to see whether the prices might be going in the right direction or not. I'm not going to go through technical analysis here, but I just wanted to say that there are certain places to start and that analysis of one instrument can be completely different from the analysis of another. You need to do your own research into which indicators you should be using, since the ultimate decision is yours, of course. I have a couple of articles on the website which you can read with certain indicators and strategies I use for entries and exits, so you can check these out later. Also, you can use the screener I showed you earlier to find technical patterns and then choose the ones you like from the list. I recommend that you take a look at that later after we finish the webinar. Well, these are the 8 steps which you should take every single time you're going to decide on an investment or a trade. If you don't follow these steps every time, you should expect eventually to have some massive failure that could wipe out any gains you might have made in the past. Because from my point of view, if you do not go through this process, you are basically gambling and not investing or trading. You might as well just go and put all your money on red at the casino, you know. It is so important for you to understand every aspect of your decision before committing your hard-earned cash. So please don't waste your money. While the steps are simple, I realize that they might not be easy to complete by everyone, or they might take a long time to do properly. I also realize that some people might start doing this for a week or two and then go back to their old ways. So don't worry, I'm going to give you a gift at the end of this webinar to help you go through this process like a real pro. Now, first let me answer some of the questions I've received. Let's have a look. Oh, sorry, I'll just have a drink. Oh goodness, so far we have over 350 questions. Goodness. Luckily they have been grouped, thank you very much, by similar subjects, so I'll go through a few of them here, then I'll do my best over the coming days to answer as many as I can directly to you, and I'll use these also to make some more videos and posts on the website or in social media. I'll start with a question here that is being asked a lot today from people who want to start, which is which broker should I use, or how to open an account to start investing and trading. So I'll go through this very briefly, since it shouldn't really take that long to explain. Please note that I just mentioned the broker I personally use, which you do not have to use, or they don't necessarily they're not necessarily the best, and because I use them doesn't mean that they are suitable for everyone either. So please take this as an introduction and then do your own research. First, any broker I am willing to use has to be regulated either in the US or in an EU country. If it's not, I'm not even going to bother looking at it. Then I always prefer a broker that gives me the following services. So the first one is I look for something that I can trade fractions. This means that, for example, a stock like Amazon, which we just saw, it is currently trading over $3,000. If the broker has a minimum of 1 share, I will have to pay the full $3,000 to buy the share. Buying fractions enables me to buy as little as 0.001 shares, for example, or $3. You can see the huge advantage of this straight away, I believe. Also, even if I have a large account and have the money to invest in such shares, I always prefer to have accurate percentages. So I would like the ability to buy, or for example, 10.35 shares instead of 10 or 11 shares. Now, another service I look for in a broker is how easy and quickly it is to deposit and withdraw funds from my account. Some of these are instantaneous, and you can do it with a credit or debit card, or even use payment services like PayPal. It is also important to consider how much the broker charges to withdraw money. Some brokers do not charge anything, while some others charge amounts like $40 or $50 each time you're going to make a withdrawal. Another factor I look at is for investments, I like to have the option of investing tax-free. So in the UK, I would look at having a stocks and shares ISA, and in the US, for example, I would look for a Roth IRA. These are two examples of tax-efficient accounts to have for investments. I will also want to look for a broker that has a broad range of instruments to invest in. For example, I have an account with a broker that only has forex and commodities, so I can't trade stocks or ETFs with them. On the other hand, I have accounts with brokers that offer only UK and US stocks and ETFs, but not European stocks, for instance. Also, I sometimes want to trade fixed income, which is bonds or treasuries. And not all brokers have this as an option. So you need to make sure the broker offers you the instruments that you are likely to trade and invest in. For trading, I usually use leverage. In Europe and most countries in the world, this is done through what is called CFDs, or contracts for difference, while in the US and Canada it is mainly done through options, as CFDs aren't available for small accounts and are actually completely banned in some states even. Options and CFDs are complex instruments, especially options, so you need to educate yourself about them first before you try to use them. Do not just follow recommendations from random sources and enter into this kind of thing blindly. So please, if you do not know what these are, start by finding some reliable educational material about them first before you jump into it. You then need to test the broker and then your strategies, etc., by using a virtual account where you trade in real time but not using real money. Do this until you are 100% comfortable, then you can start using real money. I'm including links to the traders we use, the brokers we use, at the end of the webinar to help you start your research into which ones to use. The ones I'm currently using the most actually is eToro, just because people can follow my portfolio in real time. If you're in a place where CFDs are allowed to be traded, you can also copy all my trades in real time. Unfortunately, there are some states in the US and Canada that do not allow CFD trading, but you can find out more details about this on the website under the heading Copy Our Trades. Again, I'll put a link to this at the end. Next question says, I want to invest my first $4,000. What do you think about it? Where to invest? Right, I'm already hoping that by now, after going through the 8 steps, you have some sort of idea about how to approach investments and what you should be looking for. What I suggest, though, is that if you're starting, or even if you're an expert, to have part of your investment in index tracking ETFs. Now, these are funds that follow indices like the S&P 500 or NASDAQ, and they're a great place to invest for the long term. Also, an ETF that follows gold should be on your investment portfolio. So in addition to specific companies that you invest in, here is a list of ETFs I suggest you should look at for your investment portfolio. An ETF that tracks the S&P 500, an example of this is SPY. An ETF that tracks the NASDAQ 100, for example, the ETF called QQQ. Another ETF that tracks gold, for example, ETF called IAU. You should also not invest all your money in one instrument. I know that a lot of advisors say that you should only risk less than 2% of your total portfolio in one instrument, but I disagree, which is a bit controversial with this, especially if you have a small account, since the 2% can be extremely limiting. But you need to have a diversified portfolio, whatever you do. So here is an actual example from my own personal accounts. My long-term portfolio, which I've had for 15 years now, I only made a few changes in it over the years, focusing mainly on high dividend yield investments, which saw me grow this account by over 330% during this time. The last time I traded it was in 2020, when I sold everything in the portfolio towards the end of February. And then I bought again from April to June, and now it currently only has 3 ETFs, which follow the S&P 500, the NASDAQ, and the US 7-year treasuries. As for my medium-term investments, you can see most of my positions on my public eToro account that I just mentioned. Again, you'll find links to all of these at the end of the webinar. Next question, are all forms of technical analysis lagging? Well, if they weren't lagging, then it would be called a crystal ball. No, on a serious note, the technical analysis is basically looking at historical patterns to try and predict the behavior of what happens next. So if we look at the charts, sometimes you can see certain patterns that are clear, and this is what we try to do in technical analysis. I'll go back to my gold example from earlier. I'll change this to the daily time frame, and I'll zoom out to look at how the patterns formed over the past 10 years. Let me also just take out some of the indicators just to keep this as simple as possible. Right. The main thing we can see here is the behavior of price around the orange line, which is the 200 exponential moving average, as well as the white line, which is the 50 EMA. First, we can see that when the price is below the orange line, there was a downtrend. So even here, when the price rebounded, it still respected the trend and went back down. It was only when the 50 EMA crossed the 200 EMA here that we started to get a change in the trend. So this could be something to that we look for, which is the behavior of the 50 EMA relative to the 200 EMA. They are lagging, but we can still tell more or less how the price will behave. Then if we zoom in a bit, we can see the behavior of the 8 and 21 EMAs relative to the 50 EMA for shorter periods. Next question, predicting cryptocurrency trends and how risky it is trading on private exchanges like Coinbase, CEX.io, etc., as they are unregulated and private companies. Also, if you could help with how one can mitigate the risk in this. Okay, right. I'm not really an expert on cryptocurrencies, but they are an investment instrument like any other, so I can talk about them from that perspective. I also trade crypto from time to time when I see clear opportunities. My last two Ethereum trades were just amazing. So the first thing is the exchanges. Not to get into technicalities, the way I get around this is by simply trading crypto through my regulated broker. The spreads might be wide, but I would rather pay that little bit extra and be safe than risk my money in something that I'm not sure about. For example, the spread now on Ethereum in eToro, if I'm looking, is about, say, let's see, $16. This means that if I buy Ethereum, I will immediately be in a $16 loss, and it has to go up $16 before I break even. So all I have to do is make sure I account for this in my expectations before I take the trade. I hope this makes sense. I can see a few questions about futures and options. I'll go through these briefly. Futures are contracts to buy the assets in the future. Let me go to my screen to look at an example of futures. Right, so for example, if we're looking here at Brent crude oil contracts for we can see different contracts, and let's look at the April contract. It reflects what the market thinks the price will be in at that time. We can see that now the market is pricing it at a lower price than January or February, suggesting that the sentiment towards oil is relatively negative in the longer run, because they're not expecting more demand in April than they're expecting it in the next month or two. Futures prices move with the current price, or what we call spot price. If you remember from our mention of oil prices in step 2, when we were talking about themes and said that contracts were negative, this meant that these futures were trading under zero, because they reflect the contracts that the physical oil traders have. Now, options are a different type of contract, where you are buying a contract with a specific price of the instrument in mind. For example, instead of buying the $3,000 Amazon share expecting it to go up in value, you buy a cheaper contract called a call option. I'll go into one of my accounts with options to show you this. Right. So let's assume that you are expecting Amazon to go up to $3,000 before June. So you would buy, so we would click on June, you would buy a call option that is for a strike price of less than $3,500, for example, with a specific date in the future, say end of June. If the price of Amazon goes up, your contract or option becomes more expensive, and you can sell it, or you can keep it until expiry and then buy Amazon share at the strike price, regardless of how much the share price will be then. Options have so many different variations on how you can trade them, with spreads, iron condors, butterflies, and so many other strategies. So again, I suggest that you find a proper, reliable course to study about options before you even try and trade them with virtual money. If I go through all these questions, unfortunately we'll be here for 2 days. So what I'll do is that I'll go through all the questions once we're done, and I'll just try to answer them over the next few days. Also, if you have more questions and you didn't post them in the chat here, please send them directly to me, and I'll be more than happy to answer as many questions as I can. My email is markets@roundsquareventures.com. That's markets@roundsquareventures.com. Right, now on to my gifts to you for sticking with me until this point. The first of my 4 gifts to you is that I've prepared a document for you summarizing what I've just spoken about, as well as a section with the links to some useful sites, articles, brokers, etc. I tried to include as much information as possible in this document to give you an easy reference for most of the details you need. This is part of a book I'm working on at the moment, which will be published in April, hopefully. You will also receive a free copy of the book as soon as it is out. It will retail at £29.99 or $39.99. But I'll be giving it away for free to every single person who joined me here on this webinar. I'll be leaving the link here in the chat now, so you can download this document. It will also be available at the end of the webinar with some other material. My second gift is a 15-minute virtual meeting with myself where you can ask me anything you want about investing and trading. Please note that I don't give individual investment advice, but I'm happy to answer questions about subjects you'd like to know more about. All you have to do is write the word meeting in the chat, and on the 31st of January I'll put all the names into a random name picking app and will contact you so you can arrange our meeting. So I'm picking one person from anyone who writes the word meeting in the chat now. On the 31st of January, I'll pick that one person to arrange the meeting with. I normally charge $500 an hour for my consulting services, so this is worth about $125, and I'm happy to give it absolutely free to help you as much as I can. So write the word meeting in the chat here so we can have this one-on-one conversation. Now, to tell you about my third gift, I'll show you something first. If you remember, I mentioned at the beginning that my job has been market analyst, and I have been providing my analysis of the markets to these institutions in order for them to make the best choices. Instead of them going through all the news every day and try to interpret it into something useful, I would do this for them. I could see the orders as well as the flows from retail and institutions, and I could see where sentiment might be heading. I could also see how certain events can have an effect on sentiment as well as on fundamentals, and try to get something useful out of any potential discrepancies between fundamentals and sentiment. Some of the largest institutions used to pay us upward of $500,000 a year for this service. Since we had research analysts, economists, as well as market analysts like myself, who would gather all the information and put it into a meaningful format, as well as do all the field research, as well as meetings with managements and governments, as I mentioned at the start. But on average, smaller institutions that just got the reports and updates paid around $75,000 to $100,000 a year for this service. This is why it is completely out of reach for most retail investors, if not all of them. So I have started, well, let me actually go here and I'll show you this. I have started RSV markets to help small retail investors and traders with providing them with similar tools that the large institutions have. And I had to make sure it was affordable to anyone. So in addition to this free webinar and the free content on the website that we provide regularly, and all the free content on social media, I also wanted to give you access to our main reports service to ensure you have every tool possible to get to succeed consistently. Let me show you what this service is first, and then I'll tell you my gift to you. We give our market commentary twice a day, every day, once before UK market open and once before US market open, highlighting any economic or political events that could have an effect on markets, talking about investments, monitoring flows to gauge sentiment, and say exactly what we are doing during the day. Let me show you this in action. This is the UK version of the daily market cheat sheet for the 1st of December, but I'm just showing it to give you an idea. The report starts with an overall look at the macro picture on the day, highlighting any events that we see as important to the market. For example, on this specific day, we're looking at PMI figures. Large British retailers were going bankrupt. And Brexit talks between the UK and the EU. We then go on to interpret this into how we see things progressing during the day, starting with indices. We follow this by which stocks are on our watch list and why, and maybe also which ones we are avoiding on the day. We talk about these from both an investment point of view as well as trading. If we see opportunities for the day. After that, we talk about commodities, and we mainly focus on oil and gold every day. This is then followed by our take on forex and which pairs would be trading on the day and any specific events that may be affecting them. The last part of the page is how we are approaching the markets and any other insights we believe are important. For example, here we are talking about how we saw overnight futures rally in indices and what we thought this could be, as well as any other factors we considered as crucial on the day. The following part is usually charts with the best technical setups for the day. We also include indices, commodities, forex, and stocks in the report on that day. Just we did not like any of the commodity charts, so we did not have any. The commodities we include in these reports are a bit more than what we write about, so they may include soft commodities like corn, wheat, soybeans, or sugar, energy like natural gas, WTI crude or Brent crude oil, and gold and silver. Each chart includes the time frame we are using and an explanation of what we're looking at. Here, for example, this is a chart for the Euro Stoxx 50, and it is in the 15-minute time frame. We have identified a down channel and put the support and resistance levels with the stop loss and every other explanation that we can include on there. The following part of the report is actually what I consider to be the most important one, and it is the calendars. We compile all the important events for the day, starting with which companies are reporting their earnings on the day, including when this is going to happen and what the analysts are expecting the results to be. This way, once the earnings are announced, you can immediately tell whether or not they were good. We also highlight the ones we are looking at ourselves or which we believe most of the market is following. The next calendar is the ex-dividend calendar, which is, and again here, the last day the share needs to be traded in order to get the dividend. This example here is, for example, Goldman Sachs shares that day we would expect a payment of $1.25 on the 30th of December, and the dividend yield would be 2.24% yearly. The economic calendar is my personal favorite since it includes all the important economic data when they're going to be released, the last reported figures and market consensus, once again to compare the actual figures. The ones highlighted in yellow here are events of great importance, and they usually have the most effect on the country's currency, or in the case of oil, for example, it would have an effect on oil prices. If the data is released before the report is sent, we already include the actual figures. They're green if they're better than the market, or red if they're worse. The last part of the report includes some analyst upgrades and downgrades of companies. We can see here, for example, United Airlines was upgraded by the brokerage called Raymond James, and the change was that they changed their view of the company, and now it's outperform, and that the fundamental target price is $60 according to their valuation. You can also see some downgrades here. Sometimes these have almost immediate effects on share prices, especially when they come from respected analysts. This also can be a source of ideas. For example, I didn't know about this company, Rhythm Pharmaceuticals, before looking at the report. So I could have looked at this company on the day to see if it was interesting for investing in or for trading. Again, I'm putting a link to this report in the chat, and again, I'll put a link to it at the end of the webinar for you to take a look at it at your own time. Let's have a look at our weekly. In addition to the twice a day, we have the weekly market preview, which is a great resource for swing traders as well as day traders setting up for the week, and for investors to get a general idea of what's happening. It has the same format as the daily cheat sheet, but with the view for the whole week. Again, it starts with the macro picture and goes into more detail about indices, stocks, commodities, and forex. We then have the charts for the week, which include some indicators on the daily or the 4-hour time frames, and brief of what we are looking at. The weekly charts will always include the three main US indices, the VIX, the FTSE 100. The charts will always include Brent crude oil and gold in commodities section, and then forex and stocks will depend on our watch list for the week. We then have the same calendars as in the daily, but including the whole week. We can see here the earnings calendar, the ex-div calendar, and the economic calendar. We do not include any broker upgrades or downgrades, since these are changing on a daily basis. Right. So again, I'm including a link of this report here in the chat, and you'll find the link again at the end of the webinar. Moving on to our monthly. So our monthly market digest is more of a bigger picture report, looking at the month ahead and trying to figure out what factors to look at both for investors and swing traders. It follows a similar format as the other two, so I won't bore you with repeating the same information, but there is an additional section to the monthly, which is the top quant picks from a good friend of mine who has a genius quant model that has been consistently profitable for over 10 years. So every month we include this, his top picks, which are picked purely through a very complex model that he has created and that his clients pay top dollar for. Again, link in the chat for this report, and it will be available at the end of the webinar. Now, as I said, let's go back to the website. And as I said, normally institutions buy this type of service for tens of thousands of dollars every year, but what we have done in RSV markets was to offer this at really affordable prices, which is either £35 a month or £350 a year, where you get 2 months free basically. Now, my gift to you is the following. Instead of just giving you 1 week free trial to start with, I am offering you 2 weeks instead. This way you can have enough time to learn more if you're a beginner, set up your account, discover the best way to use these reports, and hopefully our reports help you out a little so they can actually pay for themselves later on. If you think the reports won't help you, you can always just cancel at any time by just clicking the cancel membership button on your account, and that's it. To get the offer, all you need to do is go to the subscription link, which I'm including here in the chat, and also be included at the end. Find the membership, either monthly or yearly, that you want, click on it, then inside you have to click on the click here to enter discount code. You enter the discount code Jan 2021, then you can proceed to the checkout page and complete your registration, and this will give you 2 full weeks access 100% free. So again, the code is Jan 2021. I'm including it in the chat, and it will be included at the end of this webinar. Now, the fourth gift I'm giving is that anyone who registers through this offer, I'll pick one of you at random every month for the coming 3 months, starting the 31st of January, and will give you 6 months free membership. So 100% free for 6 months. Even if you've already paid for a yearly membership, you'll get your membership extended by 6 months. So just to tell you about your gifts again, let's go through them. So the first one is you're getting a document with the full 8-step process to invest and trade like institutions. This also includes other useful information, some technical analysis setups, and links to several handy sites, some of which I've mentioned and used in this webinar. This is part of a book that will be published in April, and you will also get this book completely free. It will be worth £29.99 or $39.99, and you are the first to get your hands on parts of it now, and I will make sure you receive it as soon as it is published for free, 100%. So this is actually 2 gifts in one here. Now, the second gift is a 15-minute one-on-one virtual meeting with myself for one winner picked at random from this webinar. All you have to do is write the word meeting in the chat here. So again, if you haven't written the word meeting in the chat, please write it down so that you can be entered into this draw. The third gift is a 2-week free trial of our full membership program, where you receive our daily market cheat sheets twice a day, weekly market preview, and monthly market digest. Institutions pay a minimum average of about $75,000 for this service, and you can have it pay for itself by making use of the first 2 weeks. You receive it for free. The fourth gift is that at the end of every month, starting the 31st of January, for the next 3 months, we will pick at random one of the people who register for our membership program to offer you 6 months completely 100% free membership worth £210. So remember that if you have any questions, you can always write them here in the chat, or you can always send an email on markets@roundsquareventures.com. That's markets@roundsquareventures.com. I'll answer your questions as soon as I can. Once this webinar is finished, you'll be taken to a page which will have all the links and details mentioned here. And again, thank you so much for joining me for staying until the end. I'm currently working on a webinar to explain some really important market dynamics, which I'm very excited about, as I share some rather important elements of market dynamics that most retail traders and investors don't even know anything about. So I hope you found this of some use, and I hope to see you again soon. Thank you.